Morning, my fellow Taco Tuesdayers. It is 6:13 in the morning, and it's a good thing that you slept last night because had you been awake and watching the futures, it would have put you to sleep. I mean, horrific. We're going into Tuesday, and this is going to be a quick video because there is absolutely nothing to discuss. Less than 30-point range yesterday. They broke the streak. They gapped down. They closed red on a Monday. Yeah, we closed above the open, but there again, you have your email that went out midday yesterday. It's included in today's email for what I am calling my trade of the week. Trades of the week. Had them all work out. So we'll see how this one is. Hopefully, it's not one that we need to close. It's one that we ride like all but one full credit for the end of the week. So here we go. Range dead. Up 10%, up 112, 102% above the COVID low, 14.5% year to year. There's absolutely nothing to cover. Nothing. That trade I put out early in the morning, 44.20, 44.15. Oh, sorry, but it worked. The getting that red close just they wouldn't give it up. So, QQQ, dead day yesterday, 3-point range, 1.5-point gap down, closed green above the open, closed red below the close from Friday. Dead day. So, quickly, here we go. Charts, SPX. This is the chart that's in your email showing you Friday's gap, but the reason it is the way that it is elongated. 100-day moving average, 5-day moving average. 5-day moving average is moving up. 100-day moving average is moving down fractionally. 10-day moving average moving up right to the 23.6 retracement, which has been moved because we moved 4 points higher. 43.46.72 basically fills the gap from Friday. The gap from back on November 3, 43.34 is 43.17, and then you get to your 20-day moving average, which is moving up. Your 200-day moving average way down here at 42.58 to put things into context. In the middle here, right there beyond around that minus 10% line is your 50-day moving average. Up above, as I've said, 44.34. It's just, you draw it on your chart, you understand why. QQQ, looking at a 3-day chart. And again, that's why I was saying QQQ, big problem getting above that 378.51. And I believe, from my view, that's going to continue to be like that. VIX didn't fill the gap from the weekend. Still hanging here right around 15, but you get CPI coming out in a couple hours, and that will resolve everything. So I put NVIDIA onto your chart just to show you your RSI, which really doesn't matter to anybody because everybody wants to smoke NVIDIA crack. It's the new fentanyl. 6-hour wider time frame chart coming up slowly because Thinkorswim is slowly. This is your earnings gap from back in May when they invented the way to say AI, and they are reporting. Take this into context, okay? They are reporting earnings on Tuesday, November 21st, after the market closes. The day after that is the biggest travel day in the United States as everybody goes to travel for Thanksgiving. Thanksgiving, markets are closed. The day after that, on Friday, is a half trading session. So you can, decipher it as you wish. The 200-day moving average is down here at 364 at the top of the gap, having rarely ever seen visits below 400, and it doesn't take a mathematician to go and look at this. 392.30 to 491.16 as of now, almost 100 points, almost a 25% move on a $1 trillion company. So as we're going into CPI today, I will leave you with the one and only Tom Lee, because until the CPI report comes out, all we're doing is, talking shit.
Tom, here's the good news. I mean, here's what I worry about, and you were right. But if this number comes in even slightly off, are we doomed? Because has this 8% rally already been the expectation of the softer number?
Brian, you might be surprised, but I think institutional investors and retail have been fighting this rally. You can see it in the put-call ratio. Yes. The put-call ratio today hit 1.26. That's an extremely elevated reading. It's been rising the last 2 weeks. And if you look since the October 27th rally, every time an intraday 1.2 is or higher has been hit, we've rallied hard the next day. So I think into this print, if it's a little hot, I think people end up having to buy this dip because hedge funds have been shorting this rally. I know sentiment's negative, but I actually think the probabilities favor a slightly softer reading. The skew is for a hot reading, and I think we could get something that could feel like a face ripper like we had in July. So there's a possibility of quite a positive move tomorrow if it's a soft reading.
So basically, markets are likely to go up if it's hot, and markets are likely to go up a lot more if it's cold.
That's right. I think it's...
And I mean cold coming in at like a 2.8.
That's right. Yeah, it's really going to be the core month over month. Let's say so 0.3 is the consensus, and Goldman's and the JPs are at 0.36.
So you're looking at the month over month, not the year over year that I referenced.
Yes, but the year over year matters. On the core, it's still 4.2 year over year. So something below 4.2 would be considered a soft side reading.
Face ripper.
Possibly face ripper.